We have Romina. She actually works as a... Okay, so first question. I had a lot of clients talk to me recently.
So when I speak to a client that is up for renewal, I have 3 questions to ask, which start with,
What is the gap between the current fixed rate and the variable rate?
variable has performed better than fixed rates. Always. Maybe
Hey guys, so I have a special guest for you guys today. We have Romina. She actually works as a mortgage pro here in the GTA, the Greater Toronto area. And obviously we're able to do loans in Ontario, if I'm correct, Romina?
all over Canada.
All
All
over
across
Canada,
Canada.
apologies. So
Yes.
we can do mortgages all over Canada. So she has a wealth of knowledge. And the reason that I have her on here is because I'm going to ask her some quick questions that a lot of people who are maybe getting into the market and buying new properties, looking to get mortgages, or people who already have a mortgage, they're up for renewal and have a lot of questions about the mortgage environment today versus when they got into their mortgage. We're going to get a really good understanding as what our options are and where we can take this in 2024. So without further ado, Romina, thank you so much for joining.
Thank you, Danilo. It's a pleasure to be here with you and your audience, obviously.
Definitely, really appreciate it. Clients come to me all the time and they have a bunch of questions for me when it comes to mortgage. I try to answer some of them, but in a lot of cases, I refer to the professionals. I do focus on obviously finding the deals, buying and selling homes for my clients. But when it comes to mortgages, I definitely refer to the pros. And this is why we have you on here, because we have some key questions that I've been getting really over the last few months. Obviously, a lot of interest rate changes in Canada and around the world, and it's impacting people's decisions. Okay, and so I'm gonna give you some questions here that I've been getting recently, and hopefully you can help us out the best approach. Sound good?
It's my pleasure. Sounds perfect.
All right, perfect. Okay, so first question. I had a lot of clients talk to me recently because their mortgage is up for renewal. Okay, either this year, 2024, or maybe in the next couple of years. I think majority of mortgage holders in Canada are probably coming up for renewal in the next couple of years here. And so there's a lot of questions because they're going from a low interest rate environment to a high interest rate environment. And if somebody's coming to you with that type of question or that type of scenario, what would your approach be, and what options do they have?
Yes, thank you for giving me the space to talk about this one particular topic that is so relevant right now for all those borrowers, right? All those people that have mortgages. The majority of mortgages, the book of mortgages for the whole country are up for renewal within the next 2 years.
Yep.
So it is something that is going to be very shocking for everyone, going from a 2% rate to double of that. The way I approach the conversation with those that are interested in refinancing or renewing, so let me just differentiate the two. A renewal is when we're just staying with the same mortgage lender, same amortization. So it means that if you got your mortgage 30 years amortization, which means that you would be paying it off within these terms by the year 30. By the time you're up for renewal, let's say you have 25 years left. When you're renewing, you are starting there at 25 years and then you continue going down.
With the same lender?
It could be a different lender, that could be a transfer, but it's technically a renewal. Yes,
Sure.
you're renewing the terms. The only thing that changes is the rate.
I got you. So, you have a 5-year term, you're at the end of the 5 years almost, and you're renewing at this point in time, either with the same lender or another.
You can renew with the same lender. Let's say you wanted to switch lenders because the other lender has a better rate, then that would be a transfer. So we can switch or transfer.
Okay.
And that is okay as long as the balance of the mortgage stays the same and the length of time left to pay it off stays the same.
Mm-hmm.
If we're looking to get more money, or if we want to change the length of term that it will take to pay it off, then we're talking about a refinance, okay? And that could be with the same lender or different lenders.
I gotcha. Okay.
So when I speak to a client that is up for renewal, I have 3 questions to ask, which start with, what is the main goal for you and your family on this renewal? Is it best rate? Is it to improve your cash flow? Or is it to get more money? So are we changing the loan amount?
Okay.
And then we build from there.
Okay. If I get this straight, somebody is looking for either a refinance or they're under their term and looking for a renewal. They're going from a low interest environment to a high. Really, it just comes down to their goal. It's, are they seeking the best rate? because they're not really looking to, maybe change in anything when it comes to their mortgage. They just want to get the best rate out there. They want to improve cash flow, or they want to get a higher loan amount. Let's kind of speak to all three of those. So I would assume if somebody's looking to get the best rate, that means that they may be in a good position. Let's say they may not be having an issue paying their monthly commitments, but they just want to get into the best rate. What would your suggestion be there? Like, would they be going into a fixed? Would they be going to a variable? Like, what would be the option for them?
The approach in that case is to understand what is their short-term and long-term goals. Mortgages is not just about a rate. There are a lot of terms that are very important to know about and to pick them according to what you expect for the next 3 to 5 years, for example. And then we can go into fixed and variable because those are two important factors as well. If the client says, you know what, I'm thinking I'm maybe downsizing in 3 years, my kids are leaving, whatever the case may be, but they're looking for the best rate. The best rate is not going to be on a 3-year. It will be on a 5-year. So it's important to know these things, as well as if you're going to stay in this house for a long time, then you have to be careful who you pick to be your lender. Sometimes there are some mortgages that have a bona fide clause. What that means is that you can only get out of this lender or go to a different lender if you sell the property. So that may be the best rate out there, but is it really going to suit your life, your family life, or your goals? That's just one of the examples. Best rate, like I said, a 5-year is usually the cheaper rate. And if you go into the 10-year is even better. But also if it is a fixed rate, and let's say at 3 years, which is usually when people break their mortgages, if on year 3 you want to sell the property and get out of this mortgage, or you want to consolidate debt, for example, at 3 years' time, then that will incur a very big penalty.
Sure, because you're breaking at 3 years out of the 5 years, right?
Correct.
And I guess the other scenario you mentioned is let me look for the best rate. Sure, that's advertised, but you reveal that after 3 years, you're looking to downsize, maybe you're looking to upgrade, you're looking to make a change when it comes to the house. So maybe the best rate for you will be based on a 3-year rate, which like on paper might not look the best, but it might be the best option for you because of your scenario. So I understand.
Exactly.
So this is another hot topic I would say here. Let's move on to this next piece. Most people, have concerns, I think right now due to cash flow, meaning that their rate has increased either quite a bit because they're on a variable. They, got into a mortgage maybe 2, 3 years ago at even under 2% sometimes. And they might be sitting at a high 6% rate right now, and they're really struggling to make those monthly payments because it's gone up so much. Or they got into a fixed rate a long time ago, maybe they were smart, but their renewal is coming up and they're concerned about cash flow because they know when they do some math, maybe on a calculator online, they see that payment might go up, I don't know, $700, $1,000. Like that's a very real scenario. So what would your suggestion be if someone has a cash flow issue or they're concerned about cash flow now that this, mortgage is renewing in the next little while?
In that case, then it's important to see the whole picture, right? Even when they're looking for the best rate, we need to have a good analysis of the current financial situation. Do you have any other debts that you're carrying along? What are the rates that you're paying on those debts, right? If we're looking to improve cash flow, this is important to know because maybe by consolidating it onto your mortgage, we're able to decrease those monthly expenses that you have and that therefore achieve our goal, which is improve your cash flow. So this analysis is very important. You need to be very honest and be able to share all that information so that we can give advice that is more appropriate for you. The other approach we have to help clients that are struggling with cash flow is to extend amortization. So if let's say the mortgage they have is, I don't know, 20 years left, but they're really struggling and there's no other option, then we provide that as an option. Let's see what it would look like if we stretch the amortization to 30 years, which is the maximum that we have with the traditional lenders. And that usually helps out. When the situation is very tight, every little bit helps. So those are different items that we can work on with a client to improve on that cash flow.
Okay, perfect. So just to summarize, I mean, we can consolidate debt. So I know credit card debts are like 18% plus. I know lines of credit, could be at, I don't know, maybe even 8, 9% or more, and personal loans and stuff like that could be at higher rates as well. So, I mean, when you add all those things together on a monthly basis, that could be really tough. If you can refine, I know rates seem high for mortgages right now, but if you can, refinance into a loan at even 6-7% and get rid of your credit card debt, like that's going to lower your monthly commitment, right? And
Yes,
that might be an option for you. Now, I did have a question though, because I mean, I feel like this is available to certain homeowners versus others. And correct me if I'm wrong, but you probably needs to have equity in
that's
order for you to do that type of refinance. You need to have some space, in your actual home. You need to have certain value to be able to loan against in order to increase that loan amount and be able to consolidate.
right.
So it might not be something that's available to everybody, but it could be something that could alleviate quite a bit. And I guess this is normal, even in an environment that we're in right now when it comes to mortgage rates, like people do this type of consolidation in other markets, right?
That's correct. It is always a very smart idea because, especially when you're strapped for cash, right? Because you're, like you said, yes, we're in a higher rate environment for mortgages, but it's way better than what you're paying on a credit card. And also, we can stretch out the payments, right, to 20 years, to 30 years amortization. And
Sure.
what you said about how much we can borrow in terms of the equity of the property. So when we're looking at refinancing, an appraisal is required, right? So we need to know what is the current value of the property, and then we can refinance up to 80% of that amount as long as the client qualifies with their income. So
Perfect.
sometimes in order to qualify for the refinance, we may have to pay off some debts.
That might be a condition to the refinance, right? Like the
Correct.
lender might say, look, we'll approve you as long as you pay off all cards, possibly sometimes. And
Correct.
just to give you an idea, guys, of loan to value and loaning 80% to your value. So if an appraisal gets sent out, and usually the lender sends this out, an independent appraiser, they don't just take your word for it, and they determine that your
That'll be
property's
nice.
worth, yeah, that'd be nice. And they determine that your property's worth 500,000, then you might be at the maximum be able to actually loan up to 80%, which is equal to $400,000 of that property, right? So that's in the case of you wanting to get a higher loan amount. Okay, so that kind of answers that question, because you mentioned earlier scenarios for refinance. People are looking to the best rate sometimes. Maybe they want to improve their cash flow, which might include a consolidation. And the third one might be that they're just looking for a higher loan amount. It could be for consolidation. It could be because they're like pulling funds to maybe do a renovation on their home, or maybe they're going into a new project, or maybe they're looking to get a new property as well because they have a lot of equity in their property. They might be willing to go up to an 80% loan to value, or 70 or 65, whatever it is, depending on how much balance they have in their mortgage and what it's worth. And they might be able to fund other things. Looking for a higher loan amount might be an option as well at the refinance point, right?
That's right. Everybody's in different points in their lives and they have different goals. And when your mortgage is up for renewal, this is a good time to consider these options.
Okay, so I got another question for you, because there's a lot of news right now that interest rates are going to come down in 2024. So maybe it's the springtime, maybe it's the summertime, maybe it's the fall time. Who knows? But the consensus is that most pros are saying that we're going to see Bank of Canada lower rates. Now, if that is the case, I hear a lot of people saying to me, well, you know what? If that's the case, I'm only going to get into a 1-year term, 1-year mortgage term. Maybe I'll only get into a 2-year mortgage term then, or a 3-year mortgage term, because they don't want to lock in a 5-year at these rates, because it is possible that maybe in the next even year or 2 years, they might be able to benefit from a lower rate. So my question to you is then, what is the best term in 2024 if I'm getting into a new mortgage or refinancing?
You know what? In regards to the term, it really depends on the client and it really depends.
Mm-hmm.
So what I
Political correct
usually
answer.
for my clients, my current clients that are just getting into the market, for example, I recommend a 3-year term.
Okay. So
Why a 3-year term?
new people buying a new mortgage product, 3 years saying, okay, all right.
And I'm saying 3 years because it's kind of like it's not too long, it's not too short, it's kind of in the sweet spot, right? The expectations in terms of the interest rates is the general consensus. And yesterday I was in a meeting with an economist, and that's kind of what we were talking about. And he was saying by the end of this year, we're hopefully gonna see a 1% decrease. And for 2025, another 1%. So within, let's say, a year and a half or 2 years, we're looking at a 2% decrease in prime rate. So it would go at 3%, and then the lenders always add a little bit more, right? So the rates right now, let's say right now is 5%. Fixed rates for 3 years, about there. It depends if it's insured or not insured. And then what was the other part that you mentioned?
So yeah, I mean, we're just trying to see, what
Fixed
is
and
the best term
variable.
for this anyways, like, selecting the best term. how long do you want your mortgage to be? You're saying that if it's a new person coming in, a 3 year might make sense because we're kind of in that middle. Your rate might not be too high. And at the same time, you're not going to be locked in for a 5 year period. If rates do come down this year, next year, in that third year, you'll be able to maybe, hopefully, refinance it to something lower, which is going to lower your payment, going forward, type of thing, right?
That's correct. And then, but again, you have to be able to qualify, right, for
Of
that
course.
3 year term.
Of course.
Sometimes clients need to go for a 5 year rate because it's the best way to qualify, which a lot of that happened like a year or 2 years ago, where a lot of people ended up with variable rates because that's how they could qualify.
Hmm.
They couldn't qualify based on a fixed rate. In variable rates, there are two variable rates, one where the payment is fixed, but the other one is where the payment changes. And in the one where the rate varies with the rate changes,
Yeah.
those are the ones that are really struggling.
Yeah.
Those that had the property for a while, or they had a lot of equity and the rates increase like they did, but their payment stayed the same. Those not necessarily are struggling as
Well,
much.
they're not feeling the burden on a monthly basis, but I mean, I do hear that a lot of those people, their interest is increasing. So even though they don't feel that crunch on a monthly basis, they're
That's
literally owing more money every month.
correct. Yes.
So there's a
So
little
when
pain.
it's
There's a little pain on both sides. It's just some
correct.
people, feel it more than others. But
But
I
you
would
know
say,
what? They give you the option. And what my recommendation was for my client is if you can make prepayments to your mortgage. So depending on the type of mortgage that you pick is how much you can do in terms of prepayments. Some will allow you to do only one prepayment a year of up to 15 or 20%. Other ones will let you increase your payment every month, double or 20%. It really depends on the terms of that mortgage that you're with. Scotiabank tends to be one of the best in terms of prepayments. You can go up to 20%. So that's kind of helping you so that when it's time for renewal, your mortgage is not a lot higher than when you started, basically.
yeah, for sure. And I remember, people were calling me, asking me for a bit of advice on these things, saying, hey, the bank is proactively calling them, even though their mortgage term was not ending, the refinance wasn't coming yet, but because they were in a fixed, they were just letting them know, hey, look, your amortization is increasing. You're now actually
We're on a variable.
yeah, you're on a variable and your interest is not covering. So now your interest is actually increasing every single month. Would you like to, change so that you can make higher payments? Or would you like to cover? And I remember when that stuff was happening, it's crazy that that actually happened. But
It's not an easy decision, right? Because you really have to weigh the pros and the cons in that situation. Your variable rate, it usually comes along with a discount, right? So your variable rate is made up of two components. One is prime rate, that's the one that changes with the Bank of Canada, and then the discount. So depending on the lender is the amount of discount that they offer you. That is the part that never changes, the discount. So if you got a great discount of, let's say, 1.2%, in 2021. So let's say prime right now is at 7.2%. So that leaves us with a net rate of 5% right now. If you want to look in your rate,
6%, no?
What?
It's 7.2 minus 1.2.
You're right.
Yeah. So you're locking at 6%. Yeah.
Yes, you're right. So, but if you're refinancing or you're locking in a rate, you're probably at 5.49 or
I
around
got you.
there. So it's a little bit of a difference, but are you locking in for 5 years? We're expecting to see decreases, right, on the rates. So then that 6% that you have now by the end of the year is going to be 5%.
Okay, well, that actually leads us to a very good next question. Okay. I mean, if I'm getting into a 2024 mortgage, should I be going into a variable or should I be going into a fixed? If rates are looking to come down over this next 1 or 2 year period by possibly 1 to 2%, should I go into a variable
It depends
or,
on the gap in between.
or should I do fixed, right? So what would you say?
So right now, the recommendation is to do fixed. Like I said, 2 3 year term is better than a variable. But the variable,
Because the variable is kind of high right now. Like it's high by over 1%. Like what's the gap right now?
so right now, prime is 7.2, right? With a majority of lenders except TD. TD is a premium, so their prime is a bit higher. And the discounts are not the best discounts that you will see is about 1%. So that gives us 6.2 and above in terms of a
Sure.
net rate.
But you said that the fixed is what?
It depends if we're talking about refinancing or
Sure.
purchase, right?
Let's say purchase. Let's say we're getting into a new mortgage.
Is 5% we can do easily.
Okay.
The current rates, for example, I have a recent approval that I have for a purchase. They're first time home buyers. They want it to be at a 5 year because they like to know that their payment will not change for a long time. So this is kind of how they budget, and they wanted to stick to the 5 year, which also was the lowest rate at the time. I got a 4.74 for them on a fixed rate. So if we're looking again at a variable, and right now, let's say best case scenario, 6.2.
That's a big gap.
It's a 1.46% gap.
Mm-hmm.
So it's going to take us about 2 years for that to be at par. So for 2 years, they're going to save for sure. But if I were to qualify them based on that variable, their budget would be decreasing by quite a bit.
Gotcha.
If it is decreasing, then they may not even get a property, right? It depends on how big their budget is or what they're looking for, right? So these were first-time home buyers. Fixed rate was the perfect fit for them. They weren't looking to make any big changes in the upcoming years. But there sometimes life happens, right? And there are changes that happen in our relationship. For example, people get divorced or they separate. That is a reality of life. And that's one of the reasons why people break those 5 year terms, right? So 8 out of 10 people break at around 3 years when they're in a 5 year term.
80%. Interesting. Okay, well, I mean, that's actually very helpful, fixed versus variable. What is the gap between the current fixed rate and the variable rate? If we can get a 5% right now and best variable rate is at 6.5 or 6.2 or whatever it is plus, it might take about a year or two before we're at par. The other thing to keep in mind is that what is your qualification? If we use a variable rate at over 6%, you're going to be approved for a lot less house, right? Your budget is going to be a lot lower than a high 4 or a low 5. So based on all those little factors, in your scenario, that's what you go for, right? You're going to go either one way or the other. If your budget's not a concern and it's above what you're looking to buy, it's up to you to take that risk on that variable, maybe, right? Knowing that maybe in a year or two, like you said, you had a meeting with an economist that predicted possibly a 1% this year, 1% next year. I mean, maybe that variable is a good option for someone who's not really concerned about their budget. So I think those are really, really good things to consider.
It's important to also know yourself, right? Are you a person that likes things as safe as possible?
Sure. Some people are risk adverse.
That's the right word. Yes. Right. So then variable may not be the right fit for you if you're going to be checking.
It goes up and down. It goes ups and downs,
Exactly. So it really depends on you, on your situation. How much stability do you need on these payments? Historically speaking, variable has performed better than fixed rates. Always. Maybe 3 or 4 times out of the last 40 years is that we've seen variable performing not as good as fixed, where fixed comes at a lower rate. So, I mean, chances are variable is always the better option.
Except for the last 2 years.
This is exactly, that's what I mean, right?
One of those moments.
Exactly. So it really depends on each client and how risk averse you are.
And I want to make a point, actually, let's keep in mind why we're in this situation, okay? It's not a lot of different factors that impact rates and our economy. But what impacted us this time around was literally something that came out of nowhere, right? Like nobody actually expected at all. It's because of the COVID situation a few years back. Everything was shut down. Government had to make moves in order to keep the economy running. Although nothing was moving, like there was only certain, essential services or essential businesses that were able to operate. So they lowered the rate a lot. And maybe they saw after maybe a year, 1 or 2 year period that they lowered it maybe a little bit too much, and people got way too excited. So then they had to increase the rate a lot in a short period of time. And this is why we are what we are, right? And so now inflation is high and they're trying to bring it down. And I saw that inflation numbers in January were actually lower. It's trending down below 3% now. So chances are that we're going to have an interest rate decrease probably in this year, like many people thought. We haven't seen it yet, but could be coming. And so that could impact a lot of people's decisions going forward, no?
Yes.
So Canada's usually pretty stable.
We're looking for April. Everybody said June, but given the last rate on the inflation, then we're looking maybe April.
Okay, look, let's flip the script here. Fingers crossed. Yeah, I'm not sure how I feel.
It is, okay. You know what? Like things change all the time, right? We were expecting great numbers December, but then they got it modified, right? Because they wanted to use other numbers that were not really accounted for. That brought the inflation rate higher. So everything changes. We really have to play it day by day.
The reason why like I'm happy, not happy is because it depends what hat I'm wearing. If I'm wearing my business hat for my real estate business, it's good that rates are coming down because we're gonna have more activity. You as a mortgage person, me as a real estate agent, obviously more people are gonna be in the buying. Things may pick up quite a bit. They already started at the beginning of this year. That may actually become, I don't know if you want to say better or worse, but that actually may pick up even more, right? Now, if I'm wearing my investor hat, trying to look for deals and trying to get properties at a better price, honestly speaking, that could be short-lived. That might
Well,
not,
that's
we
the
may not see,
thing. That's what people
we may
need
not
to
see that.
see.
We may
People
not
need
see,
to see that.
you know what I'm saying? And then like I talked to a lot of people and a lot of people are waiting for interest rate to decrease. You might be shooting yourself in the foot because you may be paying more for a house than you would be today, and you may be running into more buyer competition as well, which who wants to, be in multiple offer scenarios with other buyers? Let me tell you, it's not fun when you're in it, okay? And it makes things a little trickier for me as well. So, I don't know, this could be a warning for you guys now if you're watching this to maybe get geared up. And if you're kind of looking to get into the market, it might be a good time to kind of get in before interest rate changes because of the same thing that I'm talking about. We may actually see increased activity
There's
and
a
maybe
lot
higher
of
rates,
buyers that
higher
have been
prices.
waiting. They have been
A lot
waiting
of pent-up
to find
demand, a lot of pent-up demand. So one thing I can tell you for sure is that we usually trend in the 6,000 to 8,000 sales per month when it comes to activity here in the GTA. And we've been at like 4,000 for the last maybe quarter and a half. Since fall of last year, you usually see that in the summertime, but then, all of fall, we were like basically trending at 4,000 sales. I think even still right now we are. So that's going to pick up. That's not normal. So there's a lot of buyers that are not buying right now, and that's going to change.
They are there. My recommendation
You've
is
been warned.
if you can qualify and you have the down payment funds, get in it. If you find the right property, get in the market. As rates go down, this will happen with the prices, right?
Right.
So
There's an
what does
equilibrium to it.
so then down payment needs to be higher, right? Because the amount of the property will be higher. And so it's really something that you have to really think about if you're really waiting for the rate.
That's a good way to look at it as well. So yes, I'm waiting for a better rate in order to qualify for something better or to lower my monthly payment. But what happens if the prices go up? That means you have to come up with more down payment. That 5%, 10%, 15, 20% of a higher price is more.
Yeah, and you will be losing on that equity that you could have gained.
I prefer gaining equity. I prefer buying at a lower price and maybe biting the bullet at a higher rate. This has been my message for the last like year and a half, 2 years. I don't know if anybody's watched my videos. I said this over and over again. If you're a buyer and you can handle the monthly payments, you're going to benefit from increased property values in the next short term, actually, the next couple of years. And when you do that refinance after a 2 or 3 year term into a lower mortgage rate, so your payment's going to go down in the future and your property value is going to go up. Just saying, I don't know. I mean, now it's becoming a little bit more closer. That reality is looking a little bit more clear. And, I hope you're listening to me about this.
It
All
is.
right.
And if we're looking at 2 year period, right? 2 year period where the rates will be where they are. Again, everything can change, right? Something can happen in the
Correct.
world.
That's the
And
estimate. I'm not saying it's going to happen for sure,
yeah,
but I mean, chances are.
that's what we see. I rather pay a little bit higher rates now because this will change easily. And my property gaining equity in the next 2 years.
Okay. So one last little bonus question here before we get off, and thank you so much so far. I think this has been very informative, really good information. I had a question recently. My answer was that we might need to immigrate if you want this, but why can't we have a 30-year mortgage like the United States? Why is the United States able to get a 30-year mortgage and not Canada? What?
I think it was in the conversation yesterday. I don't know the details, but in Canada, the most you can do is 10 years. It's just the way Canada's economy is built. We cannot have, that much money locked in for that many years at a specific term. It's just not
Yeah.
the reality for Canadians.
Yeah. That might be telling you something. What does the bank know that we don't? You know what I mean? They don't allow us to have more than a 10-year term. Anyways, I don't think I've ever met anybody that got a 10-year term, but
There has
yeah.
been some that have come up for renewals, and we're
All right.
trying to grandfather whatever the requirements were then for like qualifying, etc. But it's just not convenient, especially it really depends. I mean, if
There's a
you're
lot of movement. You said it yourself, 80% of people break their term at 3 years. So that means that they don't ever really, 80% of people don't stay for 5 years, and I noticed this even with my own clients. I've been doing this, quite a bit. We're hitting 10 years now. So I've had a lot of people that have upgraded 2 times, 3 times over that period. And if they've done that 3 times, that is consistent with what you're saying, every 3 years they did something and I was involved, so.
I did it myself when I was not in mortgages, right? I was about 3 years, I made a change. And then the next 3 years, I made another change. And now that I am more involved, obviously, because now I'm in an industry, I see it. It plays out. It's very true. It's very relevant. So you want to do a 10-year term. I don't even see how in an investment world it would even be convenient, because a lot of people, what they do for rental properties, the idea is to not sell it, right? Is to refinance, take equity out, buy the next property, and do that consistently. And that increases your portfolio, and it allows you to have access to funds as the market increases value. So
Yeah.
even in that case, 10-year would not be good, because you want to take out money, you want to refinance.
Perfect. Well, Romina, so just confirm with me here. So you're available to help people with new purchases. You're available to help people that are refinancing at the end of their term, that are refinancing in the middle of their term. You're able to help people that are investors that are looking to take out equity and buy another property. You can qualify with all that. And you're able to, as a mortgage broker, are you locked into a certain bank, shop around for clients on different banks?
Yes, so that's an important point to touch on. The difference between working with an independent mortgage agent versus the bank. I have access to over 40 lenders. So we can look for different products that are more suitable to your goals, to our clients' goals, right? So it's like if we're thinking about cars, it's like going to a BMW dealership and going to another where you can have access to all the different cars. BMW may not have the family vehicle that you need for your family. Maybe you're doing carpool, who knows? So that's why it's important to come to a person like myself, an independent mortgage agent, mortgage broker, whatever it is. The idea is that the person will be able to understand your goals, guide you through it, and give you options. At the end of the day, we advise, but the client is the one that instructs, right? They tell us how they want to go. I cannot tell you what choice to make. I can only advise you, give you the pros, the cons, give you scenarios of different options so that you can make that decision confidently.
Yeah, amazing. I mean, obviously, if I walk into a TD, they're only going to present TD options, and Scotia might have a better option. So Romina might be able to, look at your profile and figure out what mortgage products from different lenders can be the best options for you, right? Now, another misconception, and I actually had this question literally yesterday: how much do I have to pay for a mortgage broker to help me? Is it true that you have to pay a mortgage broker? I think it depends, right? Like,
It depends. It
A
depends.
lender, B lender, you have options to a lot of lenders, and some lenders are the ones who actually charge. It's not necessarily the broker or the agent, mortgage agent, right?
That's correct. So traditional lenders, the regular banks, A lenders, as we call them,
Like what?
like
CIBC,
Scotiabank,
Scotiabank,
TD,
TD.
exactly. The main banks or monoline lenders. These are MCAN, Equitable Bank. Equitable Bank, for example, they have the traditional options, A lending, and they also have the alternative. There are some of them that have those two options, but
Sure,
TD,
sure.
Scotiabank is straight traditional lenders.
If you go with these, there's no fees. Exactly. That's the
No
main point.
fees, right? They pay us. When you are talking about a private lender, for example, there is a fee involved, a fee from every side of the spectrum. So the lender will charge you a fee, the broker charges you a fee, then there's lawyer fees for both sides. It could be very expensive. Alternative lender, it depends, right? In some cases, there's only a lender fee, but the lender fee is the consistent one. And that's a 1% of the mortgage amount.
Yes.
And the broker fee, it depends. It depends on the broker and it depends on the file.
Mhm.
And that could be also up to a 1%.
And correct me if I'm wrong. I mean, you're always going to try to get a traditional lender, an A lender, a bigger bank. Like that's always the goal, However, you at least have the option to give you an alternative lending solution or a B lender solution, even though there is maybe a little bit of a charge to it, to get you into the market, whereas you wouldn't be able to do it at all at any other bank that you would walk into.
That's
So if you're in a
right.
position where you want to get into the market, this is at least an option for you. And people do go into it. I mean, I have myself in the past, right?
Yeah, especially
And I'm
when
not
you're
scared to do it
self-employed.
because, yeah, and I'm not scared to do it because, it just made sense for me to go that route at the time, right? And then usually the goal is after a year or two is to refinance back into an A, right? You fix the things you need to fix and go from there.
So yeah, I think it's important to touch base on why a B lender. So the B lender is usually when you have bruised credit or when you're self-employed and your net income is very low on your taxes versus your income on your bank account, right? So there are different reasons. If you have declared bankruptcy in the past, consumer proposal, all those are things that maybe you think you're completely out of the game because of that. But no, there are options in the market for things like this, and people don't know it. So it's important to know that if they have the interest in purchasing a property, have a discussion with a mortgage professional so that we can look at the different options, your goals, the numbers, and then we build from there. There's even co-ownership programs where they give you down payment to come up to the 20%. So
yeah, for sure. Alternative lenders have a lower criteria. It's easier for them to accept your application compared to an A lender, and so there's options for you there as well. So I think you got to speak to a broker or an agent, a mortgage agent or a mortgage broker. Romina is one of them. So Romina, like if somebody wanted to get in touch with you, how would they be able to do that?
you can give me a call at 647-999-3661 or send me an email at romina@mortgageoutlet.ca.
Romina, mortgageoutlet.ca. Perfect. Is there a social media account or anything that they can follow you
Yes,
at?
I have my Instagram account at Romina MTGS. I'm not very active there, so you won't see a lot of content, but at the same time, I'm
He's
working.
active on the DMs though, that's the most important thing, Send her a
Yeah,
message, right?
you can DM me. Is that how you say it? I'm super old school in this. You gotta educate me on this area.
And I got another little bonus for you as well. Si hablan español, Romina habla español también.
Sí,
¿Dónde
muy
eres
bien.
Romina? De Argentina.
Soy de Argentina, muy bien.
Perfecto.
Y hablamos
Entonces,
español y tenemos una meta muy grande de llegar a todos y poder fortalecer a toda la comunidad hispana en Canadá. Así que con Dalino vamos a seguir trabajando en eso.
sí, 100%. So, English, Spanish, however you'd like. Obviously, Romina knows her stuff. And so you should have the confidence in being able to talk to her to find your solutions. And Romina, I appreciate you to jump on this. I think we learned a lot about mortgages. I definitely did myself. And I think we answered a lot of like the hot topics and hot questions that people are asking over the last little while. So if you're refinancing, you're getting into the market, I mean, you should rewind and rewatch some of the stuff that we said here, because I think we have some really good gems and some tips for you to actually do it. And if you need some help from us, then obviously get in touch. You know how to get in touch with me, and also Romina just shared as well. Thanks, guys. Perfecto.
Thank you.